But it's time for our special quarter say segment, where we look at earnings expectations from sort of one sector every day, with the earnings season very, very imminent now. Rima is here to tell us what is the IT sort of sector going to look like for the third quarter. Rima, over to you.
Thanks so much for that. So considering the seasonal weakness caused by furloughs in Q3, don't expect too much by way of growth. So we're looking at just about a 1% top-line growth for Infy, for TCS between 0 to 0.5%. For Wipro, it could be a negative growth. So numbers will not be much. The question is, can commentary and guidance support the outlook? There are only 3 companies where growth is expected to be robust. One of them is HCLTech amongst the large caps at a 4% top-line growth. But that's because the products business of HCLTech typically does well in Q3. But in the mid-cap space, it's Persistent and Coforge, where the street is anticipating roughly about a 4.5% top-line growth. And these two have been the rank outperformers in the IT services pack, with about a 70 and 50% return last year. Now moving on to the guidance. Now expect Infy to raise their revenue guidance for this year. Now the current guidance is 3.75 to 4.5%. Most believe the analysts believe that the company will tighten the guidance and maybe raise it marginally. So Kotak is at 4.5 to 4.7%. Ambit goes up to 5%. But largely, as you can see, 4.5 to 5% appears to be the guidance for Infy this year. Margin guidance of 20 to 22% should remain unchanged. For HCLTech, too, the street believes the organic revenue guidance could get tightened. Currently, it's at 3.5%, but the lower end could be raised from 3.5% to about 4.5%, while the upper end will remain the same at 5%. The margin guidance for HCLTech, too, is likely to remain unchanged at 18 to 19%. For Wipro, the Q4 numbers, the guidance is seen at minus 0.5 to 1.5%. So what will the street be watching out for if it's not going to be so much about the numbers? Well, discretionary spend, has that come back? Recovery in stressed sectors like telecom, manufacturing, particularly on the auto side and in areas like Europe. Pickup in hiring. Is generative AI turning out to be a growth driver? Client budgets and even deal wins, which have been muted. Now, the Nifty IT sector, the index has given a 20% plus return for 2 consecutive years. And last year, there was a 13% outperformance for Nifty IT versus the Nifty. The Nifty IT gave you a return of 22-23% last year. Stocks started rallying last year, towards the end of last year in the second half, as growth showed signs of bottoming out and management started turning constructive on sectors like BFSI. And many stocks rallied despite a cut in the EPS. For some companies like Tech Mahindra and LTIMindtree, there was a double-digit cut in their EPS estimates, but yet the stocks gave a solid return. Just to give you one example, so for instance, something like a Wipro rallied close to about 27% last year. Again, all tilted in the second half. There were EPS downgrades, but many believe that perhaps now the run-up has become excessive. CLSA downgraded the stock recently. Citi introduced a 90-day negative watch list on the stock. So now as we enter calendar year 2025 in Q3, what we need to remember is the starting point for IT is different compared to what we had last year. Stocks have outperformed and valuations are richer. Morgan Stanley says, unlike the start of 2024, where the sector positioning was light, investors are now overweight the IT sector. IT outperformance from here on would require positive revenue and earnings revision, which according to them appears to be less given the current macro environment. So they remain selective on the sector with a view to book profits if the stocks show outperformance in Q1 calendar year 25. Their order of preference is LTIMindtree, Infy, TCS within the large caps and Coforge within the mid caps. Jefferies, on the other hand, believes that improving growth outlook will support premium valuations. They do acknowledge the Nifty IT is trading at 1 standard deviation above its historical PE levels, both in absolute and relative terms, and the valuations are rich. However, an improving growth outlook for the sector, coupled with recent earnings cuts in other domestic sectors, should support the current valuations of IT. So they prefer stocks where you are seeing strong growth visibility, and their top picks include Infy, TCS, LTIMindtree amongst the large caps, Coforge, Seasonality, and emphasis in the mid-cap pack. Back to you.
All right, Rima, thank you so much for that very, very helpful and very comprehensive wrap-up. It really tells us that it's not just earnings in isolation. We need to look at so much more in terms of market positioning, valuations, and Perhaps the big question is whether IT stocks are already priced to perfection and whether there is no room for error. In fact, let's ask exactly this to Apurva Prasad, who looks at the IT space very, very closely and has been doing that for so many years. Of course, he's from HDFC Securities. Apurva, thanks for joining in. So I'm going to start right there. I mean, Rima's nicely reminded us that stocks kept rising even when, EPS downgrades were happening all through last year, at least last calendar year. But different factors were at play. The market was stalling. People wanted to look for safe havens, and IT provided that. What happens now? Do you think companies will be able to deliver on these expectations?
Yes, good morning. Thanks for having me first. Yes, I think to an extent, a lot of positives have got priced in. But if you look at the growth trajectory, that's certainly looking upwards. So CY25 or FY26 is expected to certainly be a better year as compared to the previous year. In fact, if you look at the profit growth last 2 years, it's a very clear acceleration that is expected there. We're sort of midway through that, even if you look at where growth stands. I think what does not change is the nature of growth is it's going to remain very divergent. So you're going to have, even for this particular quarter, the gap between the fastest growing tier one and the slowest is between -1 to +5% on a YOY basis. That's much larger for a mid-tier IT company. That's as wide as -1 to +20%. So it's going to remain divergent, yet on an aggregate basis, it is looking up, and we're probably halfway to normalized level of growth that is expected.
Companies like Persistent, Coforge, this is where you're expecting better growth. Apurva, good morning. But again, I mean, as Rima pointed out, it's always the case, right? A little bit of rally, valuations get very, very full and very, very rich. By the way, the listing is also there. Indofarm Equipment, stocks starting about 22-24% on top of the issue price, 265. So it's a very good listing coming through for Indofarm Equipment, which is coming in at this point in time. Very, very strong, large volumes as well. So primary market, I mean, it was an absolute frenzy in terms of listings and IPOs towards the end of 2025, especially the first half of December. A couple of listings every day. I remember that one day at 5 listings. And I think the pipeline remains pretty strong as well. Let's see, of course, if the secondary market supports all of this action. But Apurva, go on about that point about these companies where growth is expected to be faster than your TCS, Infosys, etc. And is it actionable in that sense, or you think valuations are full?
So valuations certainly reflecting, because you look at the divergence in valuation, that's also reflecting the growth divergence. I mean, so you are looking at the set of stocks that are expected to grow faster, are trading at much higher P multiples. A good way to sort of assess them is on a PEG basis and some sort of near-term growth trajectory, which still looks fairly promising. So I think within the mid-tier, Persistent Systems is expected to sort of lead growth within the mid-tier. That's something which has been our preferred pick for a while now. I think that's likely to continue. Within the tier ones, again, like I was saying earlier, it's going to be fairly divergent, but HCLTech should probably lead, for the quarter. There is, of course, some seasonality factors driving that. But the nature of growth will remain fairly divergent in the next couple of quarters. So one has to take a stock-specific.
So, Apurva, on large cap then, where do you think one can get the best combination of potential growth as well as some sort of, valuation sanity? As, Rima was pointing out, I think one of the brokers also noted the point that many stocks are trading above the 5-year valuation averages. So, large cap, what would you like? What has the best growth prospects and also some valuation comfort?
I think from a valuation standpoint and certainly from a risk-reward standpoint, I think PCS is looking attractive. I think if you get the rest of tier one versus PCS, I think the valuations are the closest that it's ever been. I think most of the risk seems to be priced into the numbers. So I would say there could would be some upside risk if the company does back some mega deal. That's something which has been elusive for some time for the company. So I would say from the tier ones, TCS for an absolute upside, and there is certainly valuation sanity in that respect to 5-year averages. So yeah, that's the one which we like.
Also, Apurva, a slightly broader question, not so much about Q3, but this whole, Gen AI piece. And the thing is that Indian companies, even the larger ones, they're not willing to divulge any specific numbers or give us any size, estimate of the size of work that they're perhaps looking at. While obviously they all acknowledge that they're looking at more Gen AI work and, more specific projects there. So from that perspective, which are the companies that you're watching for? Not just large caps, but maybe even some of the more niche companies. Which ones would you watch out for, say, over the next 4 quarters?
Yeah, that's interesting. So I think one way to sort of look at this is to look at the largest player globally who seems to be benefiting most currently, and they're almost 6% of their deals are Gen AI driven, 3% of their revenue is Gen AI driven, and more than half of their incremental growth is Gen AI driven. So if that's to be seen as a template, I think some of the larger IT names are perhaps at a stage where someone like an Accenture was a few quarters back. At the same time, some of the mid-tier IT companies that are in the product engineering services side, I think they do have a good chance to do well. Net beneficiary, because we've seen, I think, a lot of risk seems to be a lot lower around generative AI. We've seen very strong employee additions coming together with the fact that it's a net positive, both in terms of deals and growth. These seem to be certainly positives, and I would guess that some of the larger IT teams, as well as product development services, product engineering services companies, do have an advantage in this.
All right, Apurva, we'll leave it there. Thank you very much for joining us. And, we'll request you to have come back once we start to get some of these numbers out over the next couple of weeks or so. Kicks off, of course, with the big one, TCS, on the 9th, that is later this week.